Well, good afternoon, everybody. Thank you for taking the time to join us today. For those of you who don't know me, I'm Scott Brooks, Senior Investment Consultant at Scottish Widows. It's 15 years since we launched our multi-asset pension investment approaches, and over that period they've proved to be among the most robust and reliable default lifestyle options in the market, delivering consistently solid returns for workplace pension savers. And to mark this landmark year, we wanted to create this webinar to demonstrate the developments we have made in order to achieve this feat. For those of you who are unaware, Crystal is the gift that is used to mark the 15-year anniversary. And I thought that was apt given three key characteristics of our default fund. Number one, clarity. One of the beauties of the PIAs has been their simplicity, and they're relatively simple for an employee to understand. Number two, durability. They've come through some pretty significant market events over the last 15 years. And then thirdly, number three, affordability. We've looked to keep the solution at a remarkably competitive pricing point, but not at the cost of performance. I'm delighted today to be joined on this session by Ian McGowan, Investment Director, and Maria Nazarova-Doyle, Head of Pension Investments. Together, they will cover three things. Number one, how we've adapted the PIAs to deliver in changing markets. Two, the key drivers of success during this period. And number three, what the future may hold for default fund strategies. Please do use the Q&A box on your screen to submit your questions at any point during the presentation, and we'll keep a lookout for some key themes that we can answer towards the end of the session. This webinar is being recorded, and we will share the on-demand link with everyone who registered for the session tomorrow. Today's session forms part of our expert series. We take on some of the key issues in our industry and help you navigate the changing market. We've been building this content for the last 6 months and have a really interesting webinar coming up in March on a decade of financial connectivity. So look out for the links to this and emails on our social channels over the next few weeks. Now back to today. I don't want to take up any more of your time, so let's get started. Ian and Maria, over to you.
Thank you, Scott, and good afternoon, everyone. So I'm going to start off by looking more at the historical context. As Scott says, we have 15 years of experience of our current default funds to call upon. Maria will look more at the forward-looking perspective. If I start broadly with multi-asset investing in its generic sense, the growth in multi-asset comes through very strongly indeed from the slide you can hopefully see now. Multi-asset has been the fastest growing category in investment management, along with passive management, over the past decade or so. In fact, if we go back roughly to the time we launched the defaults, it's incredible to think that multi-asset investment represented only 2% of investment in 2003, but less surprising that it currently represents around 15% of global assets under management. That position is supported by monthly sales data from the Investment Association and is also very much supported by our own customer choices that we see in Scottish Widows. There are quite a number of drivers for this. I'm not going to talk through every entry on this slide, but let me pick out a couple. The first of them, dynamic management. That is about the ability to adjust positions in recognition of prevailing and indeed projected future market position. That is something we spent a lot of time on going back nearly a year to the start of the pandemic in 2020, when we were trying to adjust portfolios to deal with turbulent markets at the time. You can combine that with low-cost access. What I mean by that, again, if you look at a provider like Scottish Widows, we use a number of different components, many of them passive. We can negotiate very low fees and make them available to customers at a low customer charge. It makes multi-asset a very cost-effective solution. And that's not to say it's all passive. We can at times combine passive and active elements and generally take an active approach in some shape or form to asset allocation. I'm going to come on to that in a moment. So let's look a little bit more at the investment theory here. This is quite a well-used type of slide. The left-hand side of the graph I sometimes refer to as the patchwork quilt. It looks over every year in the past decade at which asset classes have been the winners and losers in that calendar year. The lightest blocks here have been the best performers. What it demonstrates is that equities have tended to be good performers, but have had some particularly poor years. The UK, for example, in 2018 and again in 2020. The extension of that is that there is benefit in diversifying risk through investment in a range of asset classes, particularly where it's important to avoid a very bumpy ride. The theory then is set out on the right-hand side. There can be a substantial difference between the sum of the parts and the totality of the risk budget within a portfolio. So if you look up the build-up of the blocks that you see here from bottom left to top right, as you add up the risk from these blocks, you see what I've described as the gross risk of the portfolio. But if I look at the total risk in the portfolio, allowing for diversification, the net risk, that's what you see on the extreme right-hand side of the slide. The difference is what we call the risk rebate. In other words, the beneficial impact on portfolio from diversification as opposed to just holding these components in isolation. We see an illustration of that on this particular slide. This needs a little bit of explanation. So this slide covers our 4 pension portfolios, PP1 to 4. They have different equity to bond mixes. The bottom entry, PP5, pension portfolio 5, is our liquidity fund. But if I focus for now on 1 to 4, what I see is a yellow bar, 2019, which is highly positive for each of these portfolios, and a kind of orange bar, which is positive, but much less so for 2020. So much lesser returns in 2020 compared to 2019. But if I compare that to the FTSE All-Share at the top of that chart, again, 2019, very buoyant year, but the FTSE All-Share did terribly, roughly minus 10% in 2020. So the benefit we're seeing here from diversification is firstly around the regional allocation of equities, the international element in particular, and also the interaction of equities and bonds, which impacts these different portfolios in slightly different ways. So by comparison, an undiversified investment in the FTSE All-Share Index would have been a much more bumpy ride. Let me look back at the actions we have taken on the pension portfolios in particular. So this is in the period from 2014 through to 2020, so it's roughly half of the life of these portfolios. I could go back further to 2006, but I'm going to concentrate more on the most recent period. When we started that period in 2014, in common with many providers, we had a 50-50 split between UK equities and global equities. Sounds quite remarkable now to have that 50-50 split, but it was quite commonplace at the time. But we invested a lot of attention in 2014, not just to change the weighting to 70-30 global to UK, but also to split out the global component. So previously, we could not have gone overweight emerging markets, underweight UK or whatever, because it was in a globally balanced portfolio. What we were able to do from 2014 onwards is take different positions in the UK, the US, that kind of thing. So increased equity flexibility was a big theme in 2014, 2015. And then in 2017 and 2018, we did rather the same thing on bonds. We started off with a UK-centric portfolio, sterling bonds, and started from that point introducing an element of global bond exposure, which we carried through into 2018. So we got to a position after that where we essentially could take regional weightings in equities and bonds, and you'll see in 2019 I've included another example of what we did in that regard. So that took us to a particular position with flexibility around equities and bonds. But 2020, which I haven't included in this graph, but we'll move on to now, was a real standout year. And it was a year where we challenged ourselves very hard, not just to think about how we invested equities and bonds, but how we introduced much greater diversification into the portfolio. So there are 3 steps here that I will headline. I will move on then to slides that cover each of these separately. Firstly, we had a look at the way we dealt with equities in our strategic asset allocation model. So rather than having a split which was like 70-30 global to UK, we took a step to reduce our UK equity weighting within that portfolio, and I'll explain why in a moment. We looked hard at how we might diversify asset class mix, so to introduce a few additional asset classes that we thought would add value, and indeed to consider others that actually ultimately we concluded at this stage did not add value. And the third point is to integrate ESG considerations through the introduction of a climate equity fund. And it's worth bearing in mind here that these are massive portfolios. Our pension portfolios in total are towards 40 billion of funds under management. So these are massive decisions when we take into account the size of investment and divestment that's required to make these things happen. So if I take these themes in turn, the revised approach to the equity allocation, at the time we carried out our review, we were slightly overweight UK, so our 30% neutral position, we actually took a positive position in UK for investment reasons. We had 36% invested in the UK. And we can compare that to 6% of global market capitalisation. So the UK is relatively small in global context. And you might argue that members of UK pension funds want higher exposure to the UK and also might want to reduce some of the particularly large US exposures to technology companies. But we concluded pretty quickly that a situation of 36% weight to the UK against 6% market cap was too extreme, and we have now brought that down quite significantly to a little over 20%. I suspect the direction of travel will be further downwards. And for the remainder, the non-UK element, we now split in proportion to market cap as a neutral position. We still can take asset allocation calls in favour of one market relative to the other, but our neutral position is to go globally weighted. Final thing I'll say about that is when you move from 36% down much more towards 6%, you're introducing a lot of currency exposure. And what we did in association with that step was to hedge out half of the currency exposure of our non-UK equities so that, again, UK members were not so exposed to non-UK currency risk. And we thought that 50% exposure was the optimal position there as we worked through the review. I then move on to the additional asset classes we considered. We started off essentially with bonds and equities up to the top and slightly to the right of the chart. The asset classes that we introduced are the sort of lighter brown versions at the bottom left of the chart, particularly emerging market debt and global REITs. So we found in our modelling that reasonable allocations to these asset classes would be favourable, and we included them. And of course, there's always a balance to be struck here because you could add more and more asset classes and you increase diversification, but we want to do that within a cost budget and in particular not to increase the charge to the member. So we have to be careful about how we do it. We have to balance the fee element with the need for diversification. The other consideration we have is that we would not, as a matter of course, introduce very small allocations, 1 or 2 or 3% to an asset class, unless you're going to get to 5% or more. The risk is that all you're doing is introducing transaction costs without having a demonstrable investment benefit. And it was partly as a consequence of that the asset classes bottom right, high yield bonds and listed infrastructure, we did not add at this point. We might do in the future, although in the case of listed infrastructure, that will rely on us finding a suitable vehicle at the right price point. So this is an area we really want to keep under review in terms of the asset classes that we might add to challenge ourselves to improve diversification and get advantage of that risk rebate that I talked about a moment ago. And then finally, the introduction of ESG considerations. We decided as part of this strategic asset allocation review to invest an initial 10% of equities into a climate transition fund. So that's a fund that would bias its holdings towards those companies which were seen to be more transition ready in terms of climate change. And on the right-hand side, that gives some of the characteristics of that fund. So that fund has a number of really favourable characteristics. And indeed, if I look at the carbon intensity of that fund compared to market cap, the fund is around half of what a globally passive fund might look like at the moment. So in other words, it is already successful of reducing the carbon footprint within the fund, and we expect that to continue as companies reduce their carbon output much more significantly. We thought we'd be investing about $2 billion in that fund. It's actually now up to $2.6 billion, being 10% of equity. So this is a major commitment by Scottish Widows, and as Maria, I'm sure, will touch upon, our expected direction of travel is to significantly over time increase that percentage of investment in climate-friendly funds. So a presentation like this obviously has to give some reference to past performance, particularly when we're celebrating that 15-year anniversary. In absolute terms, Pension Portfolio 2, that's the one that has the bulk of the investment within our pension defaults, has returned 187%. So in other words, if you'd invested at the beginning 15 years ago, you would have nearly trebled your money now. And that's been favourable not only in absolute terms, in terms of a headline number, but against the ABI 40 to 85% index. And that's been a consequence of a combination of a relatively high equity weighting, so long-term investors ought to prefer equities, but also that consideration of diversification where appropriate. So I'll leave you on that slide in terms of the history of our pension defaults, and I will pass over to Maria to talk about what we're looking at going forward.
Thank you, Ian. Hello, everyone. As some of you may have already heard, we have started this year with a bang. We announced our strategy of targeting net zero across all of our 170 billion pounds of investments by 2050, with the crucial milestone of halving the carbon footprint of our investments by 2030. This is in line with the goals of the Paris Agreement to keep the global warming to well below 2 degrees over pre-industrial levels, and ideally 1.5 degrees. In addition to our 2030 and 2050 targets, this year we will also announce a 2025 target of investing in climate solutions. Net zero simply means achieving the balance between the greenhouse gases emitted and the greenhouse gases removed from the atmosphere, such that the net effect on the environment is zero. To achieve our ambition of aligning with the Paris goals, our efforts will be twofold. So we'll progressively reduce emissions in our portfolio, while at the same time ramping up climate solution investments like green technology and clean energy. Over time, the proportion of our portfolio invested in companies adapting their businesses to be less carbon intensive will increase, and we envisage that towards the end of this journey, we'll have the majority of our investments with a net zero position. There probably will be still a small proportion of investments in companies that are still transitioning but have credible plans to do so shortly. And then we will have to balance that by an offsetting investment into carbon negative assets to arrive at the total net zero position across our whole portfolio. So why are we doing this? Well, I don't need to tell you why climate change is bad news, and we all should be doing something about it. But what about the investment case, you might ask? And it's actually very compelling too, both in terms of risk mitigation and return potential. Climate risks are often thought of as the obvious physical risks like wildfires and floods, but a huge element of climate risk that bites in the here and now is transition risk. This includes policy, legal, technological, market, and reputational risk factors, and those are the ones that will impact companies not transitioning to the low-carbon economy or not doing it fast enough. Their growth will be severely limited, and we can see companies and potentially whole industries regulated out of existence or starved for investor capital and bank funding. There's a huge potential for litigation and fines in this area as well. Plus, these companies are increasingly falling out of favor with their environmentally conscious consumers and business customers who are now focusing more and more on the emissions in their supply chains. So on the other hand, there are plenty of emerging investment opportunities related to climate change. According to the Global Commission on the Economy and Climate Change, by 2030, we will need to have invested $90 trillion into the low-carbon transition to actually make it happen. So the potential is huge, particularly in infrastructure, technology, clean energy, and so on. Investors and customers alike are voting with their pounds and dollars, increasing revenues and share prices of the companies who are leading the transition. So it's all well and good, and rather theoretical, you may say. And for quite some time, we have been talking about these risks and returns as something that is coming in the future, but that future has now arrived. Over the last several years, we have seen ESG funds consistently outperforming non-ESG funds and also faring well during the pandemic, providing good downside protection. But just a few days ago, NYU Stern Business School published a very exciting new meta-study. At least it's exciting for people like me who like meta-studies, but we're all in pensions here, so I'm guessing there are quite a few similar people on this webinar. So that study is brand new and looking at the last 5 years and over 1,000 academic research papers in this area. And very interestingly, unlike the previous meta-studies in this area, they separately looked at investor results and not just corporate financial performance. And they also separated climate change out from the broader ESG considerations. The results of corporate financial performance, so these are metrics such as returns on equities or return on assets, was that 57% of studies found that climate change integration at corporate level and specifically managing transition to the carbon economy had a positive effect on financial performance. Similarly, on the investment side, 65% of studies showed positive and neutral performance compared to conventional investments. So there's only a tiny proportion in both climate and ESG research pieces where that link was found to be negative. So this study clearly shows that managing for the low carbon future improves financial and investment performance. So just let that sink in. We know it's a fact, and therefore we must start doing something about it, or we're letting our customers down and not doing our jobs properly. So what are those steps that we will take to achieve our targets? We will use a variety of tools available to us, like mandate changes and tilts, as we are already doing in the BlackRock Climate Transition World Equity Fund, which, as Ian mentioned, is currently 10% of our equities, but we're planning an increase of this allocation in the near future. We'll also rely on asset allocation changes across our portfolios, selective divestments, and stewardship and policy advocacy. I'd like to give you some reassurance here that we're not going to simply divest our way out of this. That wouldn't be right for our customer outcomes, and given our scale, we also have a role to play in supporting the real economy transition. We think of this approach as greening our own portfolio, but also greening the real economy at the same time. In the coming months and years, you will hear a lot more on this from us, starting with our targets and climate solution investments. We will also develop our approach to passive investments over time by introducing climate tilts and screens. We have carried out the calculations to understand our current portfolio carbon footprint, and we'll be sharing that with you shortly. As you can imagine, we don't have full coverage of carbon data yet, but data and methodologies are improving scarily fast in this area, so I have full confidence that soon we'll know exactly and we'll be able to reliably estimate full portfolio carbon footprint. Direct investments play a big role in the net zero transition, and we focus a lot on this in our green annuity offering, but we have a big ambition to also be able to offer these investments to our pension customers. This is the start of a big and exciting journey for us and our customers, and we will regularly update you on our progress. So putting the climate conversation to one side, let's explore how we might develop our default funds in the future. Historically, all you needed to do was to have a 60-40 balanced portfolio and sit tight on it. But a number of equity market crashes in the 2000s, coupled with historically low interest rates, have eroded the popularity of this basic approach. Once a mainstay of savvy investors, the 60-40 balanced portfolio no longer appears to be keeping up with today's market environment. There are several reasons why the traditional 60-40 mix that had worked in the past few decades looks set to underperform. So I'll just go through a number of them. So it's things like high equity valuations, monetary policies that have never previously been used, increased risks in bond funds, and low prices in the commodity markets. Another factor has been the explosion of digital technology that has substantially impacted the growth and iterations of industries and economies. So instead of simply allocating 60 broadly to stocks and 40 broadly to bonds, there is a very strong case for different weights and diversifying into even greater asset classes. So what matters in the future? And over the next 10 years, there are two major challenges to a static approach. So first, equity and bond returns in the future are likely to be significantly lower than the past 10 years, as you can see on the left-hand side of this chart. The numbers in the chart mean that the simple balanced portfolio is likely to deliver less than 5% per annum over the next 10 years. So it's not particularly good news. Second, static portfolios rely on well-behaved correlations between asset classes. This makes instability in correlations a key risk for static multi-asset investors. For most of history, correlation between equities and bonds has fluctuated around zero or within positive territory, so it could be relied on. But around the time of the global financial crisis, it turned negative, which would be the holy grail of diversification, but it didn't last long. And as you can see on the right-hand chart, in the last 10 years, correlation is all over the place, which makes it unreliable and hard to predict. We've already seen massive monetary stimulus distort the normal behavior of equities and bonds post the global financial crisis. Now the introduction of a new wave of fiscal stimulus as a result of the COVID-19 pandemic is likely to bring even further correlation uncertainty. So this all means that we need to cast the net more widely. Split in the past 15 years into stages of the economic cycle, we can see that the flexibility to use different asset classes in different cyclical environments can be very valuable. The chart on the left shows that the best and worst performing asset classes are different in each stage, and the difference between the best and worst returns can be stark. So being able to adjust the asset allocation and use different asset classes to better achieve good customer outcomes is critical. There is a plethora of alternatives, and as Ian has covered earlier in the session, we already use a number of diversifying asset classes in our default, but we're always on the lookout for ways to improve risk-adjusted returns for our investors and take all options into consideration during our annual asset allocation reviews. I mentioned earlier that we are very interested in direct investments in private markets, and this slide is meant to show why that is the case. So the chart shows average returns for various asset classes between 1990 and 2009 versus an estimate of their illiquidity. During that period, investors got paid for simply locking up their money, which was the illiquidity premium they received. Over the last 30 years, that premium was a healthy 5% or more if we look at private equity. However, in the last 10 years, there has been some erosion of that premium in some markets, particularly for private equity in the US. As you can imagine, this premium is cyclical. With equities experiencing one of the longest bull runs in history, the gap between private equity has narrowed and public equity has narrowed. So what makes us to continue to be interested in private markets is to look ahead to the inevitable time in the near future when public market returns go down again, as we saw earlier in this presentation, while private markets can be expected to continue to deliver strong returns, not to mention the additional benefits like diversification and some inflation protection. The most powerful trend driving private markets is a large-scale shift in capital formation globally. More and more companies around the world are either going private or staying private for longer. 20 years ago, the average time to an IPO for a U.S. firm was 3 years, and now it's 8 years and getting longer. An average value of a capital raising round for private businesses was around $12 million, and now it's well over $100 million. So companies are just not using public markets to fund their growth like they used to. This means that all that value is being harvested by private market investors, while public markets are being increasingly dominated by mature businesses with lower growth prospects, and the number of listed companies is falling across the globe. The investable universe in private markets is ever expanding. These markets have been growing exponentially and now represent around 10% of the global investable universe. If we also think about where the best opportunities to invest in a low-carbon transition will be, it's definitely here, in infrastructure, private equity, and private debt. There are many reasons why private markets investment is complicated in pension funds, particularly in DC, with some shown on the right-hand side of my slide. But none of those reasons are inherently insurmountable, and we're determined to keep working on the solution so that our customers can access opportunities afforded by private markets. So now that we've looked at trends in public and private markets, let's have a look at the trends in ESG investing. Last year has seen the biggest inflows into ESG funds ever, with that last column on the left-hand side now should be more than double that. So for 2020, it would be $1.7 trillion. So this trend is showing no signs of abating. This is because it's not a fad or a short-term spike. It's a paradigm shift in the way investments work. The effective ESG integration could be the biggest shift in investment approach since modern portfolio theory. PwC estimated that just by 2025, 57% of funds in Europe will be managed with explicit ESG integration. So this is definitely the future of investment. Equities have led the way here, but academic and industry research has shown a trend towards developing models and tools for ESG integration across all asset classes. There is still work to be done in all these other asset classes, but this area is shifting fast with a lot of innovation and product development focused on ESG. Very soon there will be no non-ESG alternatives, and this will become simply the way we invest. So I often joke that the measure of the success of my responsible investment team will be all of us losing our jobs in the future as ESG becomes fully embedded into the investment process everywhere, so there will be no need for separately focused ESG teams. So I'm just conscious that some of my ESG teams are on this call, so don't worry, you're not losing your job just yet. We have come to our final slide, where I'll try to reinforce the point of why we think our PIA defaults will continue to deliver just like they have done over the last 15 years. We have continually evolved the approach to ensure we keep pace with changing markets, regulations, and member needs. So this manifests itself both in the glide path design changes and asset allocation changes we've implemented over the years, and strong performance we delivered to our customers without leaving anyone behind, which is very important. It makes a lot more sense to us to evolve our existing solution where so many of our customers are, instead of launching yet another default as soon as we have a new idea and leave existing customers in a legacy solution. We have 2.6 million customers in PIA funds, and we will continue to look after their interests. This is also the reason for our focus on ESG, as ESG integration makes us better investors on our customers' behalf, as we look to improve their long-term risk-adjusted returns by taking account of ESG risks and opportunities. Between our dynamic strategic asset allocation, wide asset class diversification, and ESG integration, we feel that the PIA default offers a very good value for money at only 10 basis point cost when it comes to investment fees. Our economies of scale are fully at work here, allowing us to offer this great product at such a low fee. Robust governance wraps around all of our activities and developments to ensure member interests remain protected. And this brings me to the end of my presentation, and all that is left to say is happy birthday to our PIAs, and I very much look forward to the next 15 years. Thank you very much.
Thanks for that, Ian, and thanks for that, Maria. Really appreciate all the input into the last half an hour of the session, and I hope you've all found that of use. There'll be a good number of questions that have come in, so that's great. I will run through some of these questions. We'll run through the questions up until about quarter to the hour when the session is meant to end. So I'll give Maria a little time to get her breath back, and we'll have a few questions that we'll direct to Ian to begin with. And the first one, Ian, that's come in is on the, I guess, the glide path. So it's probably more a statement rather than a question, so I'll leave you to kind of comment on it. I've always considered that starting de-risking of investments 15 years out from the intended retirement date is too soon. I personally think 5 to 7 years is adequate. Also, read the 30% remaining in equities at retirement date for all of the PIAs is too low, particularly those in the adventures approach, given that most of those entering FlexiAccess will have long-term investment time horizons beyond retirement date. I'll leave you to comment on that one, Ian.
Yeah, so I think these are, you could make a number of decisions in terms of designing a glide path, and they wouldn't necessarily be wrong. I mean, the reason that we start de-risking 15 years out is because we actually start with quite a high-risk approach in terms of the equity and risky asset level. So the higher that level, the sooner you probably want to de-risk. So that's a conscious decision. I mean, compared to our peers, we do have a higher equity level in the early years, and we de-risk slightly sooner. What I'm also slightly conscious of is that, of course, we de-risk 15 years from a normal retirement date or a selected retirement date. And of course, you don't quite know when you're setting these things up when people are going to retire. They might retire a bit early. So you don't have certainty at the 15-year point as to how far out people will be from retirement and indeed whether they will go through that intended path. Again, I agree with the theory that if you're going to remain invested for a long period, actually you could hold your nerve much longer on equities, so you could hold equities much more significantly into retirement. It's quite an unknown at the moment, though, because, of course, we've only had pension freedoms a handful of years now. And what we don't know at this point is that people who have deferred their retirement and might stay in a more equity-based strategy, are they going to do that for a few years? Are they going to do that for 20 years? Are they going to do that for even longer? And with that uncertainty, again, it's a bit like the start of the glide path that I mentioned. You're probably not going to be quite so brave into holding a high equity level, knowing that actually somebody could annuitize before you expect that to happen. So I think the investment theory of holding your nerve and holding a high level of risky assets is sound, but when you're dealing with these things in general terms rather than in client-specific terms, you're going to just be a little bit wary of the scenarios that you might encounter.
Thanks, Ian. Another one for you. I'll let Maria continue to get her breath back. The last 15 years I've seen PI deliver near 10% per annum returns. What about the next 15 years, and what can we look forward to?
Well, the answer is, of course, none of us really know. And it is very difficult. I mean, if I look at, for example, at the assumptions that we feed into our investment modelling, we're obviously in a low inflation, low interest rate environment at the moment. There's no suggestion that's going to continue. Corporate bonds, gilts will probably earn, somewhere between kind of 0 and 1%. If you add an equity risk premium, global equities, you probably get to an expected return of something like 4% per annum. So with an equity bond mix, you might be 3-4% per annum going forward. But if there's one thing that I can tell you for sure is that number is going to be wrong. We have absolutely no idea what it's going to be. It's not impossible, of course, over a 10-year period that we could see double-digit returns again. We obviously start from a relatively depressed place, particularly in the UK. But equally, we could see a much less favourable outcome, and actually that uncertainty is even more prevalent at the moment when we really don't quite understand how the world is going to get out of this coronavirus and when. Clearly, we hope the vaccine will kick in, and we'll end this year with coronavirus largely being a thing of the past. But there's so many other scenarios that could have an influence on short-term returns, which feed into what we'll see over the next 10 years. So, Scott, in summary, it's not impossible we'll see the same returns again. Highly unlikely. I would have thought from a multi-asset portfolio, if you're going to get 3 or 4% per annum over the next 10 years, that's probably as good an estimate as we could give.
Thanks, Ian. We all say that past performance is no guide to future performance, but none of us actually believe it. So back to Maria. Maybe a couple of questions from Maria, in particular, I guess, around ESG. So the first one is great that you introduced an ESG climate fund in 2020. Can you talk about how much exposure is ESG risk managed and or what climate change-related exposures look like? Thanks.
I don't know, maybe it's just me, I'm struggling to understand the question. So I've kind of spent some time in this presentation to cover how we approach ESG, and there's kind of different levers we can pull, and particularly in the default. So we have this allocation to the BlackRock Climate Transition Fund, which is a tilted fund and also has exclusions in. We have worked really hard to introduce exclusions, ESG-related exclusions across our whole default, and we very well on the way to have full coverage in the PIA default for exclusions as well. So working with within our own mandates, but also with our partner investment managers, when we try to influence change, even where we don't have direct control. We're quite serious about our stewardship ambition and our approach to stewardship. So, in some of our funds that are not within the PIA, we can actually kind of direct voting and control stewardship activities if we feel the need, so we'll work very closely with managers on that. And then obviously, given that the holdings are the same, largely the same as what they are in the PIA, so everything we do on stewardship, translates into improvement for PIA customers as well. So I hope this answered the question somewhat, but if I misunderstood the question, then just please send another one in the question box.
I was going to say, if it's not online, obviously just follow up with your Scottish Widows contact, and we'll obviously pick up that question separately. On a kind of similar theme, Maria, are there any plans to offer 100% ESG default fund for self-selection on scheme setup?
Well, we're hoping that the PIA default will be 100% ESG soon. And the problem is that there's no specific definition of what ESG means, So would you consider it ESG if all the equities are in the BlackRock Climate Fund? Or would you consider it ESG if we manage to get exclusions to 100%? Or what if we can demonstrate active stewardship? Would you consider it ESG? So it's the debate is still raging in the industry in terms of what specifically would mean ESG. But over time, we expect within the reasonable time frame, I suppose, to make sure that whole default is ESG integrated insofar as possible, using, asset allocation, using tilts, using stewardship, using screening. So, as many tools as we can use in our box. Because I've mentioned before, it's very important for us that we leave no one behind. So it's much harder for us to do because it's such a massive default. As Ian said, it's £40 billion now, so it's hard and it takes a little bit longer. But that means that we continue to deliver for our customers rather than just launching something new on the side. Then, we just give to new customers. But then in 3 years' time, we might have another idea, and then these customers will become, our legacy customers. So I hope that this approach resonates with the industry, that we try to do the right thing for all of our customers. And at the same time, if you really want an ESG default, we're super flexible on bespoke options. So come to us and we will build you what you want. So while we try to look after our existing customers, and take that existing kind of flagship default that we have into the future by integrating ESG fully into it, we're also happy to take into account, your scheme's personal preferences and build a separate default. So we're not stopping anyone and we're not making everybody wait till we get to 100% in PIA.
Ian, I'll ask you. I'll skip back to you just to again give ESG a little bit of break for a moment. A hot topic. Given the recent rise in cryptocurrencies, is there any plans in the future to include crypto in portfolios? Just curious to know how pension providers view the recent surge in these cryptocurrencies.
No plans whatsoever. Clearly, the issue here is we're dealing with, in the end, the scheme member is a retail customer. There are certain investments that are just beyond, I think, the reasonably assumed risk appetite of a retail customer. I should also say that it wouldn't pass muster from our fund assessment perspective either. I mean, these are incredibly hard things to value, and getting to what's at the heart of them and what drives their performance is incredibly difficult as well. My own view is that we would be pushing customers to a level of risk which is not only high but also unquantifiable. And I think actually from a regulatory perspective we wouldn't be allowed to do it anyway. So no, it's not on the agenda.
I think I knew the answer to that one, to be fair.
Yeah, I should have left you to answer that one, Scott.
Let me maybe have one final question, and I'll target it in Maria. And it's, again, back to ESG, that ESG seems to be at the front and centre of the investment community right now. It's had what we might call a number of false dawns, but is ESG here to stay this time?
Thank you. So I hope I've kind of covered that a little bit in my presentation as well, so I could just give you another passionate speech on this, but I do believe it's an actual change in the way we invest. ESG is just better data. So it's more data now that we realize that some of this kind of non-financial data is actually financially material, because we behave different as consumers, we behave different as investors. We actually start putting value on this stuff that we never used to value before. And I kind of highly recommend Mark Carney's brief lectures on this point as well, in terms of what we should be valuing and how. we're changing completely and how we live our lives and how we invest. So ESG is now completely to stay because that data makes us better investors and makes investment managers make better decisions, assess companies better, and assess the sustainability, longer-term sustainability of an investment, and not specifically just kind of looking at climate change, but overall, will consumers continue to favor it? Will regulations impact this company in a positive or a negative way when it comes to those softer factors that we used to think, but actually they're coming to the fore? So I think we're just in a different world right now. That's why often, looking too far in the past data doesn't give us the right answers. But, in the last few years, we are starting to see this in the past data as well, and it's only going to increase.
Thanks, Maria. And thank you. I think that's been what I would describe as a whistle-stop tour of default funds. So thanks again to Ian and Maria for leading us through the last 45 minutes. Thank you again to all of you for attending today, and thanks to those who have trusted Scottish Widows to look after you and your clients' money. And I promise you we don't take these things for granted, and we do know that you have choices. As I mentioned at the start, the recording of the session will be emailed to you, and we'll pull together a Q&A document, anything we didn't have time to cover. And there was a number of other areas that we will look to capture in that document. But do get in touch with your relevant relationship team if you have any other specific questions. As we close the webinar, a feedback survey will appear on your screen. This shouldn't take any longer than a minute to complete, and it really helps us to plan for future editions of the Expert Series. So we much appreciate if you were able to leave your thoughts. That's it for today, but we do look forward to future webinars and that content coming out shortly. Thank you and goodbye.